Recent reports from major news outlets suggest that tensions between the United States and Iran may be entering a critical phase. According to multiple media sources citing officials within the administration, the U.S. military has increased its regional readiness, and policymakers are weighing their options in the coming days. At the same time, political leaders have indicated that a decision regarding next steps could come soon. While diplomacy remains the stated preference, preparations in the region show that the situation is being taken very seriously. This matters far beyond geopolitics. Developments in the Middle East, especially involving energy supply routes and global stability, have historically influenced the prices of gold and silver. Right now, two major forces are unfolding simultaneously: rising geopolitical tension and a pending U.S. Supreme Court decision on tariffs. These factors can influence precious metals in different ways, and both could shape markets in the near term. Gold recently approached record highs, while silver has also seen strong movement. What happens over the next few days could determine whether these metals continue climbing or experience short-term corrections. Let's begin with the geopolitical picture. Military analysts note that the United States has increased its presence in the region, including naval deployments, air assets, and missile defense systems positioned across key strategic areas. Such deployments are not uncommon during periods of heightened tension, as they provide deterrence and operational readiness. Aircraft carrier groups, air defense systems, and surveillance aircraft are part of standard military posture during high-risk situations. Their presence does not guarantee conflict, but it signals preparedness and strategic positioning. Diplomatic efforts are ongoing. Representatives from both sides have held discussions, and officials continue to emphasize that a negotiated outcome would be preferable. However, significant differences remain between the positions of the two governments. Iranian leadership has reiterated its sovereignty and national security priorities, while U.S. officials have outlined conditions related to nuclear activity, missile development, and regional security concerns. This gap explains why negotiations remain complex. Meanwhile, regional allies are closely monitoring the situation. Global powers, including Russia and China, have increased diplomatic and naval coordination activities in nearby waters. Analysts say these movements complicate strategic planning and highlight the international importance of the region. The Strait of Hormuz remains one of the most critical global energy choke points, with a significant portion of the world's oil supply passing through it. Any disruption, even temporary, could impact oil prices, inflation, and global supply chains. Historically, periods of geopolitical uncertainty increase demand for safe haven assets such as gold and silver. Investors often turn to these metals during times of instability, currency volatility, or inflation risk. If tensions escalate, energy costs could rise, which may increase inflationary pressures worldwide. In such environments, precious metals often perform strongly because they are viewed as stores of value. Silver is particularly sensitive because it serves both as a safe haven asset and an industrial metal used in electronics, solar technology, and defense manufacturing. Supply disruptions or increased industrial demand can amplify price movement. Looking at history, gold and silver have frequently responded to geopolitical events. During past conflicts and crises, metals often surged rapidly, sometimes overnight, leaving little time for late market entry. However, the current environment differs from past decades. Today, central bank buying, structural supply deficits, and global economic uncertainty already support higher metal prices. Any new shock would add pressure to an already tight market. Now, turning to the domestic economic factor. The U.S. Supreme Court is expected to issue a decision regarding the legality of certain tariffs imposed under emergency economic powers. Lower courts previously questioned whether these measures exceeded presidential authority. If the court rules against the tariffs, it could create temporary uncertainty in trade policy and potentially strengthen the U.S. dollar in the short term. That scenario might cause a brief pullback in gold and silver. If the tariffs remain in place, inflationary pressure could persist, which would generally support higher precious metal prices. However, even if tariffs are struck down, policymakers have indicated they may pursue alternative legal pathways to maintain trade measures. Therefore, any market reaction could be temporary. When both geopolitical tension and trade policy uncertainty occur simultaneously, markets can become volatile. Here are 4 possible scenarios investors are considering. 1. Escalation. Plus tariffs remain, this combination could support precious metals strongly due to safe haven demand and inflation pressures. 2. Escalation plus tariffs. Removed safe haven demand may still dominate, though price movements could be more volatile. 3. Diplomatic breakthrough. Plus tariffs, remain metals may stabilize with modest upward pressure from inflation. 4. Diplomatic breakthrough. Plus tariffs removed, this could create a short-term correction, though long-term fundamentals may remain supportive. Even in the most bearish scenario, many structural drivers remain unchanged: central bank demand, industrial usage, supply constraints, and long-term inflation risks. For those who hold physical gold and silver, These assets are often viewed as long-term financial insurance rather than short-term trades. For prospective buyers, timing exact market bottoms is difficult. Markets can move quickly in response to headlines, policy decisions, or geopolitical developments. Investors in paper instruments such as futures or ETFs should understand that market volatility can trigger margin changes, trading halts, or regulatory adjustments during periods of rapid price movement. The broader takeaway is that we are in a period of unusually concentrated catalysts: geopolitical tension, trade policy uncertainty, supply constraints, and strong central bank demand. Markets may already reflect some of these risks, or they may not fully price them until events unfold. It is important to emphasize that conflict is never desirable. War carries human, economic, and generational costs. The goal of analysis is not to predict conflict, but to understand potential impacts and prepare for uncertainty. Over the coming days, analysts will watch several key developments: any Supreme Court decision on tariffs, diplomatic statements from U.S. and Iranian officials, movement of naval forces and regional security updates, energy market reactions and shipping activity. Precious metals, inventory, and delivery data volatility is possible in either direction. Trade decisions can influence markets gradually, but geopolitical shocks can move prices rapidly. This is not financial advice. It is important to conduct your own research and make decisions aligned with your personal financial situation and risk tolerance. The next few days could be significant for global markets, energy prices, and precious metals. Staying informed and prepared is essential. Stay aware, stay calm, and focus on long-term fundamentals. In addition to watching policy decisions and diplomatic developments, market participants are paying close attention to transportation routes and insurance costs tied to global shipping. Even modest increases in shipping risk premiums can ripple through supply chains, raising costs for manufacturers and ultimately consumers. When logistics become uncertain, industries that depend on steady flows of raw materials often increase inventory levels as a precaution, which can further tighten supply. Energy markets tend to react quickly to uncertainty. Oil price fluctuations influence transportation, manufacturing, agriculture, and electricity generation, creating a broad inflationary ripple effect. When energy costs rise, production expenses follow, and this can place upward pressure on consumer prices. In such environments, investors often seek assets perceived as resilient during inflationary cycles. Currency markets also play a role. If geopolitical stress increases demand for safe haven currencies, exchange rates can shift, affecting international trade and commodity pricing. Because gold is priced globally in US dollars, movements in the dollar can influence short-term price direction even when long-term demand remains strong. Industrial demand for silver continues to expand due to its role in solar energy systems, electronics, electric vehicles, and advanced defense technologies. As countries invest in infrastructure, renewable energy, and high-tech manufacturing, the need for reliable silver supply remains significant. This industrial demand adds an additional layer of support beyond investment demand. At the same time, mining output growth has been relatively limited compared with rising consumption needs. Bringing new mines into production requires years of permitting, development, and financing. As a result, supply cannot always respond quickly to spikes in demand, which can lead to tight market conditions during periods of heightened consumption. Central banks around the world have increased gold purchases in recent years as part of diversification strategies. These acquisitions reflect a broader trend toward reducing reliance on any single currency reserve and strengthening financial resilience. Such long-term buying can provide a steady underlying demand base. Financial markets often respond not only to confirmed events, but also to expectations. Anticipation of policy changes, diplomatic progress, or economic shifts can move prices before any official announcement occurs. For this reason, short-term volatility does not always reflect long-term fundamentals. It is also important to distinguish between short-term price swings and structural trends. Rapid moves triggered by headlines can reverse quickly, while underlying supply-demand imbalances tend to unfold over longer periods. Investors who understand this difference are often better prepared to manage volatility. Risk management remains essential during uncertain periods. Diversification, maintaining liquidity, and avoiding emotionally driven decisions can help navigate rapidly changing conditions. Markets have historically rewarded patience and disciplined strategies over reactive decision-making. While no single indicator can predict outcomes with certainty, monitoring a combination of geopolitical developments, trade policy decisions, energy markets, currency movements, and industrial demand provides a clearer picture of potential market direction. Periods of uncertainty can feel unsettling, but they also highlight the importance of preparedness and informed decision-making. By focusing on verified information, long-term fundamentals, and disciplined strategy, investors and observers alike can better navigate whatever developments unfold in the days ahead. Another factor shaping market sentiment is the behavior of large institutional investors. Pension funds, sovereign wealth funds, and hedge funds often adjust allocations when uncertainty rises. Even small percentage shifts from large portfolios can move billions of dollars into or out of commodities and safe haven assets. These reallocations can amplify price trends once momentum begins. Interest rate expectations also influence precious metals. When markets anticipate lower real interest rates, meaning interest rates adjusted for inflation, gold often becomes more attractive because the opportunity cost of holding non-yielding assets declines. Conversely, rising real rates can temporarily pressure metal prices, even when long-term fundamentals remain supportive. Inflation expectations are closely tied to both energy prices and fiscal policy. If governments increase spending in response to economic or security pressures, deficits may expand. Historically, rising debt levels and accommodative monetary policy have supported higher gold prices over extended periods. Retail investor behavior adds another dimension. During periods of heightened uncertainty, demand for physical bullion and coins can increase, sometimes leading to premiums above the spot price. Local shortages or delivery delays can occur even when global supply appears adequate on paper. Technology and digital trading platforms have also accelerated the speed at which markets react. News spreads globally within seconds, and algorithmic trading systems can execute large volumes automatically in response to headlines or price thresholds. This can intensify short-term volatility and create rapid swings in both directions. At the same time, long-term investors often view volatility as a normal feature of commodity markets rather than a signal to exit positions. Historically, precious metals have experienced sharp corrections within broader bull markets, followed by renewed upward movement once uncertainty stabilizes. Economic growth trends will also influence industrial metal demand. If global manufacturing activity slows, silver's industrial demand component could soften temporarily. However, structural trends such as renewable energy expansion and electrification continue to support long-term consumption. Geopolitical developments can also accelerate regional alliances and trade realignments. When nations adjust trade routes or sourcing strategies, commodity flows may shift accordingly. Over time, these adjustments can reshape supply chains and pricing structures. Another element worth monitoring is market liquidity. During periods of stress, liquidity can tighten as participants become more cautious. Lower liquidity can increase price swings because fewer trades are needed to move the market significantly. Psychology plays a powerful role in financial markets. Fear and uncertainty can drive rapid buying, while relief and optimism can trigger equally swift selling. Understanding this emotional cycle can help observers interpret sudden market moves more clearly. Despite short-term fluctuations, long-term value drivers tend to assert themselves over time. Industrial demand, monetary policy, supply constraints, and global economic stability remain core influences on precious metals. In uncertain periods, maintaining perspective is critical. Markets respond to evolving information, and conditions can change quickly. Remaining informed through reliable sources and focusing on long-term trends can help reduce the impact of short-term noise. As the global landscape continues to evolve, flexibility and preparedness remain essential. Whether developments lead to easing tensions or continued uncertainty, understanding the interconnected nature of geopolitics, economics, and commodity markets provides a stronger foundation for navigating the future. One additional aspect to watch is how financial institutions manage risk exposure during periods of heightened uncertainty. Banks, brokers, and clearinghouses may tighten lending standards, adjust collateral requirements, or increase margin thresholds to protect against rapid market swings. These precautionary measures can reduce leverage in the system and sometimes contribute to short-term price pullbacks, even when long-term demand remains intact. Insurance and reinsurance markets also react to geopolitical risk. When regional tensions rise, insurers may raise premiums for shipping routes, infrastructure, and energy facilities. These higher costs often flow through to global pricing structures, affecting everything from fuel costs to manufactured goods. Over time, these increases can reinforce inflationary pressures. Emerging markets can be particularly sensitive to currency fluctuations and energy prices. Countries that rely heavily on imported fuel or dollar-denominated debt may experience additional financial strain when oil prices rise or exchange rates shift. Such stress can influence capital flows, sovereign bond yields, and regional economic stability. Meanwhile, strategic reserves and government stockpiles may come into focus. Some countries maintain reserves of energy resources or critical metals to buffer supply disruptions. Decisions to release or replenish these reserves can influence market sentiment and short-term pricing. Advancements in renewable energy and electrification continue to reshape long-term commodity demand. Silver's role in photovoltaic cells, power systems, and electronic components positions it at the intersection of traditional industry and emerging technologies. As global energy systems transition, this dual demand profile may remain a defining feature of the silver market. Gold, by contrast, maintains a unique position as both a financial asset and a monetary reserve. Its historical role as a store of value continues to influence central bank policies and investor behavior, particularly during times of currency volatility or geopolitical stress. It is also worth noting that financial markets tend to anticipate stabilization once uncertainty peaks. Historically, after major geopolitical events or policy decisions become clear, markets gradually shift from fear-driven trading to fundamentals-based valuation. This transition can reduce volatility and restore more predictable price behavior. Transparency and accurate information are essential during fast-moving events. Relying on verified sources and avoiding speculation helps maintain clarity in decision-making. Misinformation can spread quickly during uncertain periods, making it even more important to confirm facts before drawing conclusions. From a strategic perspective, maintaining balance across asset classes can help mitigate risk. Diversification does not eliminate volatility, but it can reduce the impact of sudden movements in any single market. Investors often review allocations during uncertain periods to ensure alignment with long-term goals. Time horizons also matter. Short-term traders may focus on rapid price movements, while long-term holders often prioritize preservation of value and protection against systemic risk. Understanding one's investment time frame can help guide appropriate responses to market developments. Periods of global uncertainty have occurred throughout history, and markets have consistently adapted. While each situation is unique, the interplay between geopolitics, economics, and resource demand remains a constant theme. Remaining informed, avoiding reactionary decisions, and focusing on structural trends can help navigate the evolving environment. Whether tensions ease or challenges persist, the ability to assess developments calmly and strategically remains one of the most valuable tools for managing uncertainty.